For what we know, the Federal Reserve will continue raising the interest rates in hopes to battle the inflation of about 8.3% in the United States. But this is not only happening in the United States. China is facing 2.1% inflation, while Russia is battling 17.8% inflation rates reported on April of 2022. During these economic conditions, it is crucial to pick your investments with a lot of caution, and today we're going to talk about 3 different stocks that performed extremely well under harsh economic conditions by not lowering their dividend payouts. All of these stocks pay around 10% in annual dividend, which helps offset the inflation expenses. Let's start with number 1 on our list today, which is PennantPark Floating Rate Capital Limited with the ticker symbol PFLT. It is a business development company. They seek to make secondary direct, debt, equity, and loan investments. And by the way, secondary direct refers to buying and selling the investor's ownership in the privately held, private equity-backed, or venture capital companies. The fund seeks to invest through floating rate loans in private or thinly traded small market cap, public middle market companies. It primarily invests in the United States and to a limited extent in the non-United States companies. So why is it so important to pay attention to this specific stock during the rising interest rates? The fund typically invests between $2 to $20 million per funding agreement. Under normal economic conditions, the fund would expect to at least 80% of its asset plus the borrowing for the investment purposes to be invested into the floating rate loans. And as we know, the floating rate loans change the interest on the loan through the term of the repayment. Now let's look at the federal funds rate chart. On multiple occasions, we can see that it takes on average 2 to 3 years for the Federal Reserve to raise the interest rates. From 1993 to 1995, the interest rates went from 3 to 6%. From 2004 to 2006, the rates were raised from 1 to 5.25%. And now we find ourselves at the beginning of this cycle. Companies in need of capital will be more likely to take the variable loans that PennantPark Floating Rate Capital Ltd offers in order to stay afloat. The company also holds their investments in the floating rate loans for a duration of about 3 to 10 years, and this ensures the stable repayment of the dividend payouts and less fluctuation on the market even during the downturn. Shares of the company are currently trading at $11.20 a share, successfully recovering from the lows of $4.86 a share during the most recent recession. With the current stock price, the company offers a whopping 10.02% in annual dividend rates. At these levels, the stock considered to be undervalued with a 1-year target of $13.40 a share. Number 2 on our list today is Goldman Sachs BDC Incorporated with the ticker symbol GSBD. This company also operates in the financial market and specializes in the middle market in the mezzanine investments in the private companies. For better understanding, mezzanine investments represent the claim on a company's assets, which is used in times when common equity or senior debt cannot fully fund the project. Sometimes it is called bridge financing because of that. In other words, the lender reserves the right under these conditions to convert their debt into the equity of the company. This could be done for many different reasons. For instance, inability to fully repay requirements to the lender, or if the lender sees that the growth of the company will outweigh the interest earned on the debt. And this is exactly where GSBD comes in. While investing primarily in the United States, they seek to invest between $10 to $75 million per company on an annual basis. Goldman Sachs BDC capitalizes on appreciation through direct organization of some of the following debt types like secured debt, senior secured debt, junior secured debt, as well as unsecured debt, including mezzanine debt. Shares of the company are currently trading at around $17.53 a share, and during the most recent recession, they were able to recover from the lows of $10.49 a share to the average price of $19 a share. By looking over the historic chart that represents 7 years of trading, we can conclude that the price below $18.84 would be considered undervalued for this stock. This company also offers 10.16% in annual dividend as well as lower volatility during the normal economic conditions. It took them 1 year from March of 2020 to March of 2021 to recover to the levels of around $20 a share. 1 year target from GSBD is currently set at $18.50 a share. Number 3 on our list today is WHF, the WhiteHorse Finance Incorporated. This is the investment company that specializes in the senior secured loan to the privately held small cap companies across the broad range of industries. It invests in the United States and typically invests between $5 to $25 million into the companies that are worth between $50 and $350 million. Unlike Goldman Sachs BDC, who provides the mezzanine investments, WHF provides senior secured loans that consider to be less risky. The reason why they're less risky is because they take precedence over other loans in case if the company declares bankruptcy and starts selling their assets. This company capitalizes on the market inefficiencies, and they profit from the imbalance between the supply and demand of capital for small cap credit markets. This creates the opportunity for growth, especially during the shortage of capital and higher interest rates. Shares of the company are currently trading at $13.52 a share, and forward dividend is $1.42 a share, which equates to about 10.5% in dividend yield. If we look at the historic chart, we could see that the price per share used to trade at around $12.50 a share, and according to this, the shares of the WHF are overvalued by about $1. I plan on adding to my current position at levels below $13 a share. And lastly, the one-year target for this stock is set to $15 a share. All of these companies tend to do very well during the uncertain economic conditions, especially when it comes to rising interest rates. However, it is very important to do your own due diligence when considering investing into these companies. If you enjoyed this video, you will love hearing about top 8 monthly dividend paying ETFs in order to better diversify your portfolio. Just click on the video on your screen right now. Don't forget to smash the like button below, subscribe, and I will see you in the next one.